You're listening to Ron Siegel's Home and Finance Radio Show, only on Financial News and Talk. Now live in studio, your host, local and national real estate expert and consumer advocate, Ron Siegel.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries. As we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media, this is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots, you know, the actions you can take at your family, your business, can benefit from current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. But before we get into our intriguing content today, please join me in welcoming our featured guest and repeat offender.
Good morning.
Welcome back. Todd Halterman, how are you, buddy?
Hey, I'm fantastic. It's good to see the sunshine out.
This is Southern California. Well, you're not in Southern California. We get sunshine every day out here. But, you know, it's supposed, I don't know, Todd, it's going to be 80 here in Southern California today. What about where you're at?
It's about 64.
64. Okay. So, well, that's not bad.
No, not real bad. I can almost golf today.
Yeah, has the snow all dried up or melted or?
Yeah, I'm in Washington today, and all the snow melted here in Washington, but there's still a couple feet in Idaho.
Okay, gotcha. Hey, let me remind you, if you ever have any home or finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan or plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference, 800-306-1990, 800-306-1990. And of course, we are celebrating today. We celebrate every day on Ron Siegel Radio. It's, you know, why can't they make these celebrations a little easier for me, Josh? It looks like, you know, yesterday we had absolutely nothing worthwhile. And today we get to start the day with one of my favorites, bagels and lox. Yeah. So, you know, and they make these things wrong. Most places that I go to make these wrong. So first off, I love the Everything Bagel. Shirley's Bagel down along the coast. They've got several stores, Laguna, Newport, Costa Mesa. Love Shirley's Bagel. Everything Bagel. Now, I like them open face. You get more lox that way. I like to have them open face, but you have to put the capers under the lox. Otherwise, they just roll right off. My wife likes the onions and the tomato. Not for me. So let's go lox and bagel. Yes, that is today's National Bagel and Lox Day. And then you end the day, or you can go midday, National Pizza Day. Now, I have beaten anorexia, so I know the places to get all these things. Tony's Pizza in Placentia. That's the place to go. It's a deep dish Chicago-style pizza. Tremendous. Tony's Pizza right there in Placentia. And just because I can, I order it, have it, bring it home, and I tell them uncut. That way, when you get home, number one, they cut it too big. And when you get home, it's not all a mess, right? So you order it uncut. I am an expert in these things. I mean, you know, you don't get to be my size by not being experienced, not being an expert. Let's take a look. Markets, Dow Jones Industrial Average up 91 points, S&P up 10, NASDAQ up 40. Oil is down 92 cents a barrel. And, you know, we just keep on watching these things. They're moving all over the place. We are on that collision course to May 10th when we start getting good inflation numbers. May 10th, that'll be the date that we start seeing that. Interest rates, we're watching those as well. And we always watch the mortgage rates because that's what we do here at Ron Siegel Radio, right? So the bond, the mortgage-backed security, now that bond, It was doing better. Yesterday, we had a good 10-year auction on the U.S. Treasuries, but we're kind of flat right now on the mortgage-backed securities, down a little bit. The 10-year Treasury, the yield, which is odd, yield on the 10-year Treasury is down and the bond is down on the mortgage-backed. So you don't generally see those moving in the same direction, bond. But, being that it's so flat, it really doesn't make a whole lot of difference. But we're watching both of those interest rates again toward the end of the year. We're going to see the interest rates dropping more dramatically. And I'll give you a reason what we're looking at with that, because we do have a new survey that we're going to share with you in the Mortgage Minute after the break. But right now, let's take a look at Mortgage 101, brought to you by CreditSanitizer.com. You have a credit report. It is wrong. What are you doing about it? Mortgage 101. How do mortgage rates work? That's our subject today. How do mortgage rates work? And you may be wondering how we decide on mortgage rates. Obviously, you want to make sure that you get the lowest possible rate, but how are mortgage rates determined, and what can you do to make sure you have a low rate? We're going to talk about it right now. There are several outside factors that affect how mortgage rates are determined today, but you can only control one aspect of your mortgage rate, and that is your own personal factors. Lenders look at your qualifying factors to determine your risk level. The better your qualifying factors, the better the interest rate they'll offer. Mortgage rates begin with the current market rate, so you may wonder how the market affects interest rates. Mortgage rates are affected by the economy, the overall economy. When the economic outlook is good, rates tend to increase, and rates fall when they're not so great. Mortgage rates are determined by many elements, including the inflation rate, the pace of job creation, real job creation, not the ones that they reported last Friday, which were totally bogus, and whether the economy is growing or shrinking. When the economy is doing well, again, borrowers can afford more. The Federal Reserve does not set mortgage rate, but it does affect mortgage rates indirectly. The Fed controls short-term interest rates by increasing them or decreasing them based on the state of the economy. While mortgage rates are not directly tied to Fed rates, when the Fed rate changes, the prime rate for mortgages usually follows suit shortly afterward. Prime rate affects the adjustable rate mortgages and the home equity lines of credit. The Federal Reserve controls short-term interest rates to control the money supply. When the economy is struggling, as has been the case during COVID-19, the Fed lowers rates. These are not the rates given to consumers, but the rates at which banks can borrow money to lend to consumers. When the Fed decides they need to tighten up the money supply, they raise the Fed rate. While this doesn't directly increase mortgage rates, eventually banks and lenders must follow suit to keep up with their cost to borrow money from the Fed. Which personal factors affect your mortgage rate? Well, you certainly cannot control the economic factors of mortgage rates, but you can most definitely control your own personal factors. Let's dive into what you can do to get the best mortgage rate possible, beginning with your credit score. A high credit score means you're less of a risk to lenders. A high credit score shows that you pay your bills on time and do not overextend your credit. When lenders pull your credit, they see you as a responsible borrower with a low risk of default. This leads lenders to give you a better interest rate because you are less of a risk. When you have a low credit score, lenders often change the interest rate significantly because you're at a higher risk of default for the mortgage you're getting. A low credit score indicates you may not pay your bills on time or that you have overextended yourself. The credit score you need depends on the loan program you're using. If you want a conventional loan, you'll need at least a 620 credit score, but if you choose FHA financing, 580 or more credit score for most lenders, taking steps to check and improve your credit will put you in a better position to get a lower rate from your lender. The next factor you control is your down payment. Before I go on to that, hey, make sure you pay your credit card bills the right way. rsrccpayment.com, rsrccpayment.com. That'll help you pay your credit card bills the right way, even if you pay them off in full every month. rsrccpayment.com. Credit mistakes, rsrcreditmistakes.com. And credit tips, rsrcredittips.com. Down payment. Lenders want to know that you're invested in the home through a down payment and that you aren't borrowing 100% of the funds. The more money you have invested in the home, the less likely you are to default. But we do have the down payment assistance program that allows you to borrow 100%. If you put less than 20% down on a home, your mortgage rate will increase and you'll need to pay mortgage insurance. There are different types of mortgage insurance depending on your loan program. Some are cancelable and some are not. Besides mortgage insurance, if you put down less than 20% on a home, you'll also pay a higher interest rate. You're at a risk of default with a lower down payment, and lenders make up for the risk by charging higher interest rates. If you want to get lower interest rates, rsrbuydown.com, rsrbuydown.com. Loan to value ratio compares the amount of a loan you're hoping to borrow against the appraised value of the property you want to buy. The less money you put down on the home, the higher your LTV becomes, which is a higher risk for the lender. When you put little money of your own into the home, you have less incentive to keep paying the mortgage when times get tough. If you have your own money invested, though, you're more likely to do what's necessary to make good on the debt. Lenders charge higher interest rates when there is a higher risk, which means if you put more money down, you have more to lose. Another factor lenders will look at when raising your risk is how you intend to occupy the house. Occupancy. Lenders care whether your home is a primary residence, which means you live there. If the home is a second home, like a vacation home, and finally, if the home is an investment property that you'll rent out to others. Interest rates are usually lowest on primary residences because it's where you live. You're more likely to make your payments on time because you don't want to lose your home. If you have a second home or investment property and you have financial issues, you're more likely to default on those. Bottom line is that both market and personal factors affect your mortgage. While you can't do anything about market conditions, you can control your personal factors. Improving your credit score and saving for a larger down payment are two of the best ways to improve your chances of securing the best mortgage rates. Be sure to take care of what you can control about mortgage rates by looking closely at your personal factors and make them as good as possible to ensure you get the best interest rates available when applying for a mortgage. Always be sure to work with a licensed mortgage professional like us and get your questions answered. If you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, can we count on you to introduce them to us? You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, we're going to be chatting with Todd Halterman, how to protect yourself. That's going to be our subject today. How to protect, not yourself, risk management, I guess is a better way of putting it. We're going to talk with Todd about risk management of your assets. A lot of discussion on that. So we're going to chat with Todd about that one, why today's housing market is not heading into a crash, all that and more. Reach me anytime, off-air number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
79% of all credit reports have errors that should be corrected through factual disputing. You could be saving thousands every year if your report was accurate. CreditSanitizer.com provides a free credit report audit when you furnish a specific $1 credit report. You can use this information to request corrections to your report and potentially save thousands of dollars. Get your free credit audit at CreditSanitizer.com. That's CreditSanitizer.com for a free credit report audit. CreditSanitizer.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Mortgage Minute today being brought to you by our friends at Geneva Financial. When you're ready for that home loan, Geneva's got the programs and the products. You got the phone, make the call. S&P 500 now up 10 points. I think we might be going in the wrong direction, but who knows where we will end today. And every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. 30-year conforming loans yesterday, they were up a little bit, locking at 6.298. 30-year jumbos yesterday up a little bit, locking at 6.367. FHA up, locking at 6.217. USDA, that's the zero down payment most of the time for rural areas, 6.23. That was up a bit. And the 30-year VA loan, as always, the best loan on the market for those that earned it, 5.887, down a little bit. This does not tell us anything about what people might have paid for points to get lower rates, which I shared with you. How to do that, rsrbuydown.com. rsrbuydown.com will show you exactly how to do that. 5 different ways of getting lower payments. The 10-year Treasury is up 1 basis point now. The mortgage-backed securities are down 11 basis points, which means mortgage rates are up just a little bit today. And surprise, surprise, I don't know, we probably have that sound here somewhere.
Surprise, surprise, surprise.
Conference Board CEO Confidence Index, first quarter CEO Confidence Survey, which is comprised of 142 CEOs that were surveyed during the second half of January, showed that CEOs remain cautious on the economy in 2023. The index came out at 43, which is above the 32 in the fourth quarter, but still below 50, which means there were more negative responses than positive. Some of the notable stats, 93% of CEOs reported that they are preparing for a recession in 2023, although most think it will be brief and shallow. 55% of CEOs believe that a global recession is the greatest challenge for their companies. 37% of CEOs expect to expand their workforce over the next 12 months, down from 44% in the second quarter. 50% said they are reducing hiring plans, including selective hiring freezes. So the CEOs out there, they're not quite as confident. And ironically enough, it just drives me bananas. Janet Yellen out there misleading the people once again. So Janet Yellen's comments out there yesterday coming out saying, well, you can't have a recession when you've got a 3.4% unemployment rate. Well, Miss Yellen, maybe you ought to be listening to Ron Siegel Radio, because we tell you on a regular basis, recessions 100% of the time start when the interest rates are at their lowest level, not when they're at the highest level. 100% of the time. You never get a recession starting when the unemployment is at the peak. Take a look back and just look at some of the numbers. I mean, you don't have to be a rocket scientist, Miss Yellen. You don't even have to be a good economist. All you have to do is look at history. It'll tell you all these things. I had the charts. I'm going to share them with you later on our social channels. That's the Mortgage Minute, brought to you by our friends at Geneva Financial. When you're ready for that next home loan, Geneva's got the programs and the products. You just need to make a call, 800-306-1990, 800-306-1990. So let's chat with our friend Todd Halterman today. Good morning, sir.
Morning.
So, we've chatted about this in the past, and I'm getting more and more calls on this, Todd, where people are worried, as much about, investing is a dime a dozen, right? You can go on, what is that, Robinhood, and is that investing or is that gambling? I think that's probably just as it's probably more risky than gambling, because at least you know the odds when you go to the crap table. But I digress. But one of the things I'm hearing more, so there's all kinds of places to go and throw your money out as an investment. But once you get to a certain point, you're really more concerned, or equally as concerned, about risk management. Are you coming across that at all?
Well, everybody's a little puzzled about this run in January of being 8 to 10% up on the indexes. I think it's giving some Americans a little false confidence on our forward-looking opportunities. It seems like economists are really advocating for a lighter recession than we expected, earlier or last year. So things are cautiously optimistic, but there is going to be some kind of deceleration of the velocity of cash. And we're going to go through a short period of what I would call stagflation, where things are just level. Corporate earnings are waiting to come back. Supply chains will catch up. But never have I seen a major recession where there were help wanted signs everywhere, Ron. So there's a lot of confusion in the economy.
Yeah, and it doesn't help having the confusion coming out of with government numbers. I mean, I went over on Monday when we did a deep dive over the weekend looking at the jobs report, And the BLS jobs report, raw data showed 2.5 million jobs lost, yet we report 517,000 jobs gained. The household survey showed 81,000 jobs gained because they had 810,000 they added because of a population control adjustment. So you got all those numbers coming in there, and then you look at the ADP report, which I say is the only one that's accurate because it's got 25 million records of real people, and they say 106,000 jobs gained. All these different numbers, and how could people not be confused?
Yeah, and when you see the market swelling up like this, it's based on current news, current information. Corporate earnings are coming in mixed. Some, like Disney, are getting a real big jump in their value right now because they're turning their earnings around, and they brought in Iger. But there are still some real risks out there in the marketplace, and we expect more volatility. And because the market's bounced back to what it looked like it was about this time last year, this is a time where people should rebalance and prepare for the next chapter. And that's really what we're spending a lot of time on right now, is trying to help clients assess their risk properly and adjust things while we're at what I'll call a neutral position, and be able to help them with the forward-looking environment.
So the question I would have, because I'm not in this world, I follow it a little bit, but no, I'm not from a different planet. Some people might say that, but I'm from, I'm not watching all the financials, but the vast majority of the companies that are getting a boost in their stock price in this earnings season, the consistency that I see is, even like Disney. Disney's stock price went up right after they announced that they're going to lay off 7,000 people. Right? Zoom says they're going to lay off 1,300 people. Amazon's laying off. Microsoft's laying off. All these companies are laying off, so their stock prices go up. Is that the catalyst for raising your stock prices, is laying off labor?
No, I think that's an adjustment to the net profit because the liabilities are going out the door. But the reality is it's really about action. What is leadership doing to drive distribution, grow their revenues, increase their bottom line by lowering expenses? And using Disney as an example, Iger has a long history of helping Disney get back to the brand that they've always been. And their media division took a real hit last year while they were getting their parks opened up and at full run as well. We see Disney as an opportunity. They are the leader in that industry, and they dominate. But they are having some systemic problems. And in order to improve the bottom line for the stockholders, cutting out some of that labor is a very effective way to begin trying to right the ship.
And Iger's got a great history of doing the right thing. So, unfortunately, Iger made the same, my opinion here is he made the same massive mistake that Jack Welch did at GE. They're great at running the company. They don't seem to be quite as good at finding their successor. So
Exactly.
that's just my thought right there. But so you've got this run up, Todd, where the markets, and some people will refer to that they maybe as, I think they call it, a dead cat bounce, right? The market's in a downward trajectory, but you get a great month or an exceptional month in January. How do we protect those assets? How do we mitigate some of that risk? Is it simple as what you said, rebalancing, or is there more to it?
Well, there's more to it. Obviously, it depends on how somebody wants to invest, what their time horizon is. So none of this is recommendations. It's just general information that we share so people understand they don't have to just hang on and wait for things to come back. Right now, we're really encouraging people who have portfolios in the index to start considering owning individual companies. In our firm, we go buy profitable businesses with huge economic moats, and they lead their industry or sector. Other investors these days are buying S&P 500 index, MSCI, NASDAQ, and they're writing the indexes. And the indexes really, they've got a lot of excess risk in them due to the volatility. So we believe it's smart to go out and find those cyclical companies with huge distribution that lead their industry, that have huge cash piles. They've got sustainable profits, and they really have a systemic advantage over their competitors. So we're looking for big companies with big profits, and there are many of them like Microsoft and Amazon and even Google that are down 18, 20, 30% right now off their high, and they dominate those industries. So we're helping people reposition into assets that will weather storms. And if people are in the indexes, we've got a solution we'll talk about in the next section and how to still stay in those indexes, but protect your principal if this market does go down in February like it did in August after the July run.
So, Todd did mention something there that I should have when I introduced him, but I do want to make sure that it is clear that, Todd and I chat all the time, online and offline. Todd is a great, great educator. He is a financial planner. He is not giving financial advice this morning. He's educating us. If you would like financial advice, he does that many, many mornings. In fact, probably almost all of them. But you got to call him to do that directly because everyone's situation is different. And they have to go, when you're a financial planner, they've got something called KYC, I think is the acronym. And before you can actually give out advice, the regulators say that he has to know your client. So it's something that is, we want to make sure we honor that with Todd, and we appreciate him coming on and sharing with us. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. When we come back, why today's housing market is not headed for a crash. We'll talk about that and more. You can reach me anytime. Off-air number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio, your home and mortgage connection.
Is your budget getting blown up with high prices of gas and increased costs for other household needs? This is Ron Siegel, host of the daily Home and Finance radio program. Did you know if you have a low interest rate mortgage along with auto debt, credit card debt, or student loans, your family could potentially save $500 or more per month by restructuring these debts? If you'd like a free Borrow Smart analysis with our team, let's book an appointment to see how we might be able to relieve some stress. Schedule your appointment at rsrbsa.com. That's rsrbsa.com for your free Borrow Smart analysis. rsrbsa.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The real-time real estate segment today being brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. Now, you got even more at the rsrhomescout.com. You can find out the value of nearly any property in the country. 97% of the properties in the country that are available for sale are listed there. And you can track all of your finances there as well. rsrhomescout.com. Why today's housing market is not headed for a crash. That's a subject. 67% of Americans say a housing market crash is imminent in the next 3 years. With all the talk in the media lately about shifts in the housing market, it makes sense why so many people feel this way, but there's good news. Current data shows today's market is nothing like it was before the housing crash in 2008. Back then, mortgage standards were less strict. During the lead up to the housing crisis, it was much easier to get a home loan than it is today. Banks were creating artificial demand by lowering lending standards and making it easy for just about anyone to qualify for a home loan or refinance an existing one. As a result, lending institutions took on much greater risk in both the person and the mortgage products offered. That led to mass defaults, foreclosures, and falling prices. Today, things are different, and purchasers face much higher standards from mortgage companies. If you're watching us on RonSiegelRadio.tv, any of our socials, or the ABC News and Talk AM 1490 video feed, you're going to be seeing a chart the Mortgage Bankers Association gives us to help tell this story. In this index, the higher the number, the easier it is to get a mortgage. The lower the number, the harder it is to get that mortgage. So you can see in there, if you go back to the housing bubble in June 2006, the number was 868. Again, it's just an index, so don't worry about what that means. It's the index. It's all based on the index. Now it's 103. That's about 90% lower, 85% lower than where it was. Just shows how different things are today to the spike in credit availability leading up to the crash. Tighter lending standards have helped prevent a situation that could lead to a wave of foreclosures like the last time. Foreclosure volume has declined a lot since the crash. Another difference is the number of homeowners that were facing foreclosure when the housing bubble burst. Foreclosure activity has been lower since the crash, largely because of buyers today are more qualified and less likely to default on their loans. Again, another graph. This one's from Adam to show the difference between last time and now. Foreclosure starts in the past, massive. Now, they're really minimal when you think about it. They were a little lower during the COVID time because there was a ban on foreclosures through the government-sponsored entities. So even as foreclosures tick up, the total number is still very low. And on top of that, most experts don't expect foreclosures to go up dramatically or drastically like they did following the crash in 2008. Bill McBride, founder at Calculated Risk, explains the impact a large increase in foreclosures had on home prices back then and how it's unlikely this time, quote, "The bottom line is there will be an increase in foreclosures over the next year from record level lows, but there will not be a huge wave of distressed sales as happened following the housing bubble. The distressed sales during the housing burst led to cascading price declines, and that will not happen this time." There is a short supply of homes today as well. Historic context. There were too many homes for sale during the housing crash, many of which were short sales and foreclosures, and that caused prices to fall dramatically. Supply has increased since the start of this year, but there's still a shortage of inventory available overall, primarily due to years of underbuilding homes. Again, another graph shows the National Association of Realtors to show how the month's supply of homes available now compares to the crash. Today, unsold inventory sits at just 2.7 months supply at the current sales pace, which is significantly lower than last time. And I will share with you, if we took out the houses that are showing as available but already under contract, that would be even lower. Bottom line, if recent headlines have you worried we've headed for another housing crash, the data should help ease those fears. If you want to talk about this on your individual situation, give me a call at 800-306-1990, 800-306-1990. Be more than happy to share that with you. And if you have any friends, family, or coworkers looking to buy, sell, or borrow on real estate, have them give me a call at 800-306-1990. Happy to chat with them. That is the Real-Time Real Estate segment brought to you by the area trusted real estate professionals of Ron Siegel Radio. Visit rsrhomescout.com, rsrhomescout.com. Yeah, Joe Ingram says he's too young to remember 2008. If I didn't know better, I would say that you probably might have been on something, but I know that you don't do that stuff. So, and I know you're old enough, Joe, so let's not even go there. Continuing our conversation, Todd Halterman is on the line with us this morning in studio. He is a financial advisor extraordinaire. He is an asset protection specialist extraordinaire. Not giving financial advice this morning. We should just call him Professor Todd. So he's out here educating today. Professor Todd is with us. So, Todd, we were talking before about, you were talking, when you go and invest in an index, my take on this, and you'll have to correct me, is when you're investing in an index, number one, it's cheap. You get what you pay for. Number two, it's easy. And, if you invest in an S&P 500 index, it's going to be there forever. They're going to take stocks, they're going to put companies in, they're going to put them out. But, they're cheap and easy. You're not going to maximize your returns by going cheap and easy. That's my perception. Am I right?
Well, It's like anything else in the index. It's all about when you want to take your money out, and you're using time as your risk mitigator. And economic cycles, true economic cycles, swing in 15 to 17 year runs. Secular cycles are somewhere between that 6 and 9 year. So indexes are for people who really want to wait a long time to use their money and are trying to keep expenses low and keep their asset allocation simple. The challenge we find is that there's so much compression in the market with manipulation that we've seen the last 15 years with many different fiscal policies, that the index is volatility has really never been higher. And every 10 years, we're having 100-year events. So those that want to invest in the index, really 6 to 12 big companies in that index drive the index pressure. And we subscribe to a philosophy. If you want to be an index investor, let me teach you how to mitigate some of that volatility risk so you can get better growth rates and you don't go down as much or at all with the index when it corrects. So those of you with an index investment, you should be listening to this, because I'm about to teach you how, for no fee or less than 1.25%, you can have liquid options to protect your investments in the market against loss. And so index investors do have options, and they can still get it no fee to low fee. But you know what? The general public's not real educated on some of these trusts that exist to give people that opportunity.
It's amazing that, this just baffles me, Todd, because, I'm working with a very, very high net worth individual right now. And, he wanted to buy a piece of property. So he went and we did a private money loan for him at like 9% interest. It's quick, it's easy, you get it done in a week. I don't know, maybe it's 10% now. I don't know the exact numbers. I look at the most sophisticated investors in the stock market, and the last time I did any research, the most sophisticated people will go into hedge funds, and they're paying 3% management fee and 20% of the profits. 20% of the profits. And they're happy to do it because they realize that, you're getting what you pay for. They're all they care about. They don't care about how much they pay. They don't want to be foolish and overpay, but what they are wanting to do is they care more about what's the return net than what am I spending? Right. So on that index, what can you just give me a hypothetical on an index? And I don't want exacts.
I'll give you an example. My own money. In June, I thought the market was going to be looking to bottom out or be close. So I set up an S&P 500 trust index fund where I put it into the market in June. And you know what? The market wasn't at a bottom. But what I set up for myself was, if the market went down 10% or less in 1 year, so from June to June, then if the market's down 10, if the S&P 500 index is down 10%, my principal is replaced and they add 10% to my total. So my neighbor in the index fund is at 90,000 and I will be at 110,000. So come June, my anniversary date of this trust, we look to see how the S&P 500 did over the last 12 months. And if it's down 10% or less, I will get that return in a positive interest rate. If the market is up, then until the market goes up more than 21%, I get 100% of the growth. So minus 10 to plus 21 is what I got when I deposited my money in that index trust. And so I'm going to make a positive return at minus 10 to plus 21.
Pretty significant. Those are great numbers where you don't have to worry about the challenges of that going down. When we come back, I want to chat with you though. So right there, we're looking at minus 10 to plus 21. When we come back, what I want to look at is, if we just went into the S&P 500, like what was the last 6 months of the S&P 500? I'll see if I can find that number while we're at break. You can reach me anytime. Our off-air number 800-306-1990, 800-306-1990, or ronsiegelradio.com, facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
79% of all credit reports have errors that should be corrected through factual disputing. You could be saving thousands every year if your report was accurate. CreditSanitizer.com provides a free credit report audit when you furnish a specific $1 credit report. You can use this information to request corrections to your report and potentially save thousands of dollars. Get your free credit audit at CreditSanitizer.com. That's CreditSanitizer.com for a free credit report audit. CreditSanitizer.com.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. The Your Credit Matters segment today being brought to you by CreditSanitizer.com. You have a credit report and it's wrong. What are you doing about it? Credit Sanitizer has these solutions for you. You just need to make that call, 800-306-1990, 800-306-1990. Continuing our conversation this morning, Todd Halterman is with us, educating us. Professor Todd, we'll call him today because his day job, he is a financial advisor, but we're not getting financial advice from him. We are just getting education. So if you're listening to us in the last segment, I was chatting about the idea, Todd and I were talking about being cheap and get what you pay for. So I just looked, Todd, at the S&P 500 index 1 year, going back 1 year, and it's down about 1/4% from 1 year ago. And just off the top of your head, I don't want it exact, but can you give me an idea of what the expenses are on a just a basic old S&P 500 index fund?
About 17 basis points on the Vanguard index portfolio.
Okay, so you're paying, so that's fancy for saying less than 1/4%.
Yes.
Right. So just want to make it simple. I'm a simple guy. So you're going to pay less than 1/4% on an index that's down 1/4%. So you're off 0.5% for the year by going with an index, down 0.5%. So think about that concept of what Todd was talking about in the last segment. Had you called Todd to set up something similar to what he set up for himself, you could potentially be up. You know, we don't know what the next 6 months are going to be because it's a 1 year hold. Well, this is going back 1 year. So Todd, just go based on this. If we look back a year, so this is up, this is down about 0.5%. Based on the index and the fees, you lost about 0.5% on your index fund. How would that work if we had set that up on the program that you're talking about?
Well, there on most of the chassis that we use, there's no fee or a very low fee. But in that instance, if today was the anniversary date, then that client would get their principal returned, and then that 1/4% interest as a positive deposit. But more importantly, their neighbor is down 1/4%. They're up 1/4%, which is a 0.5% difference. But I'll tell you, if it's down 4 and you're up 4, your neighbor's at 96,000, you're at 104,000, waiting for the bounce back. So, you know, if your neighbor's down 15%, from 100,000 and you've got a 10% buffer against losses, your neighbor's at 85,000 in their S&P index fund, and you, my friend, are at 95,000 waiting for the bounce back because 10% of that loss is covered by the trust.
See, that's good stuff right there. Now, you made another comment in the last segment, Todd, I want to dig into because this is one that's not widely known. And you made the comment that, you know, there's a handful of stocks are driving the entire index. And I know that I think I heard one time last year that if you took the big 5 tech companies that was like 40% of the gain in the NASDAQ. And if you took all the rest of them in the NASDAQ, which is what, another 4,000 companies, you're probably losing money. And Jack Welch built General Electric by doing exactly what you said, right? He wanted to, when he went out and bought a company, while he was considered it by many the greatest CEO ever, he went out and he said, I only want to buy company. Read it in his book. It's not me guessing. It's in his book, that he only wanted to own companies that were number one or number two in their industry. And if they ever dropped out of that, he wanted to sell them.
Yes.
Kind of what you just said.
We don't buy stock. We buy profitable businesses with competitive advantages and huge economic moats. So
explain that. What is an economic moat?
An economic moat means they've got about 5 years of operating cash in reserve to run their company through any recessive cycle. They've got a history of profits that are going up at least more than 10 years. They have a distinct competitive advantage against their competitors in their industry, in distribution, research and development, and of course, what I'll call profit. So an economic moat helps that company sustain itself through positive and negative events in the world. And we look for individual companies that can give our clients protection, because a profitable business stock price might be broken. And I'll use Google as an example, but the company is not broken. And if anybody closes their eyes over the next 10 years and imagines what artificial intelligence, robotics, and technology will look like 10 years from now, Google is going to be at the center of all of that. This is a great time to own a company who's profitable and who's growing, and they own the internet.
It's just amazing. And again, that's not any kind of an advice for you to go buy Google today, unless you want to call Todd and find out if that's what's right in your situation. It's for education.
It's an example of what I'm talking about with an economic moat.
Yeah.
And the reality is there are many stocks up over 20% in the last 12 months. So we find there's an advantage to being a sniper and going out and building assets for folks with companies that we love, because those balance sheets of those companies are way stronger than our government and stronger than the index.
Yeah, so they don't have a $31 trillion deficit.
Yeah, and they actually operate in the profit. So yeah, we look to give people selection and individualism and protection. And if they love their index investments, we absolutely use the index, and we do have index portfolios, but we put risk management around it because it doesn't cost any excess cost.
Yeah, you look at a company like Google, and I've just got it on my screen right now, that it looks like it closed a year ago at 138, and today it's at 94, 93. So the question becomes, is the company, what is that? Probably about a 40% drop, something like that. Does anybody really believe that was it wrong then, or is it wrong now? Because the company is not that much less valuable at this point.
The stock price is broken right now due to many factors, and I won't go into those details, but that company is not broken. And so we try to help people at this time rebalance and look for opportunities to buy things on sale that we believe have high conviction of opportunity in the next 3 to 5 years. And you don't chase returns, you buy profitable companies. And our index investors who have been down in the last year are getting their principal back, or they're getting positive returns because of our dual direction program. And our clients aren't coming in with losses or resentment. They're coming in with opportunity.
And I like the way you put that, Todd, that, company like Google, just think about that. You would, if you had a favorite pair of shoes or handbag or sport coat or glasses, sunglasses. Now, say you wanted a pair of Oakley sunglasses, and they're, I don't know, $100 a pair. I have no clue how much they are. But you could probably go and buy them for $60. Right? Same concept as Google right now. It was 140. Now it's at 97 or whatever. It's on sale. But you have to know which are the right ones, because not just because it's cheaper. I wouldn't be buying Bitcoin even though it's 2/3 off of its high. Right. So I would not be doing something like that. That's just my opinion. you got to have a great financial advisor. Todd Halterman is that financial advisor, asset protection guru. I know that he also gets involved in helping people through his associations and relations with stock and financial planning and tax planning and all those good things. Succession planning. So if you want more information, want to meet Todd, give me a call at 800-306-1990, 800-306-1990. And as always, I ask at that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean, who are engineering us today. And, of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or ronsiegelradio.com. And remember, make a lot of money so you can help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel Radio.
My boss just pushed me over the